A few questions, a few answers, and out comes your investment plan. Automated investment services are now on the internet. Can technology really replace private banking? We've turned to Michel Girardin, professor of macroeconomics at the University of Geneva, to tell us what he thinks about this new trend. Michel, good afternoon.
Oh, hello. Hi, Nicolette. Yes, well, to answer your question, the answer is yes. The rule of the game is crystal clear. Everything which can be automated today will be automated today and tomorrow as well, but at even a lesser cost, at a lower cost. So we have now this new industry which is emerging, which we call fintech, financial technology. And it's a fairly new industry. It's very promising, but needs still a bit of fine-tuning.
So you have tried those services. Aren't they a little bit simplistic in the way they approach private banking or wealth management?
Sometimes they give their answer as a mixed bag. For instance, here you show the site of Wealthfront, which I've tried. And what you have to know is that this site was created in Palo Alto, and their chief investment officer is a professor called Michel, who wrote a book, a very thick book called A Random Walk Down Wall Street, where basically over his 800 pages he goes along and along saying that markets are efficient, you cannot beat them, hence you should only buy passive funds, index trackers. And so the first oddity which I found on this site is whenever they say, what are you looking for in terms of financial advisor? It says, I'd like to, and you want to tick the box, I'd like to match or beat the performance of the markets. If you normally believe in passive investment, which is what their chief investment officer is doing, you would not ask this question, right?
Because you can't beat the market.
You can't beat the market.
Theoretically.
Right. If you believe in market efficiency, which is what the robo is supposed to believe in.
So what have you tried? And what kind of answers did you get? And how expected were they?
Well, I found that they were both, how should I say, they meet some of what I believe in and some of what the academic research shows, but they were not logical. They did not fit the logic of passive investment, which is the one that the robot is supposed to embrace. Hence, I went to and gave some answers in terms of how old I was. So I said I'm 49. I make $100,000 or Swiss franc a month. A year. And I have a net wealth of 500,000 Swiss franc. And then he asked me, what is your target? Do you want to maximize gains? Do you want to minimize losses? A bit above. So I said maximize gains. And then just to double check your answer there, he says, what would you do if the market tumbles 10%? Would you buy more? Would you sell all? So I said, I would buy more, so aggressive. So I gave all these answers. And then what I did is I changed, and he came with an asset allocation with some passive investments in each of the boxes of that asset allocation. But the key factor was that he suggested I should put 87% of my wealth in equities. So the allocation to risky asset was very high. And then what I did is I changed just one parameter. I changed my net wealth. I said, no, sorry, I missed a few zero. It's not 500,000 Swiss franc, which I have as net wealth, but I have 50 million. And then what I saw was that the allocation to risky assets changed. It moved from 87% to 94%. Ooh. And this link between the fact that the richer you are, the more risk-prone you are. So there's a link which is shown by academic research that rich people are more likely to take more risk, although it's not an exponential link or linear, it's a concave function. But there is that link. But that link goes against market efficiency, which is what the robo is supposed to tell you.
In other terms, you shouldn't have a difference whether whatever your worth is, the allocation should be more or less the same.
Your asset allocation, your allocation to risky assets should only depend on the volatility of the market, but not on how rich you are, nor your age.
Interesting. So it's clearly not all about market efficiency.
Indeed. So I tested the robot also on the sensitivity to my age. So I said, oh, sorry, I told him my true age. It's not 49, it's 88. And then I saw that I changed the profile somewhat too. I said, okay, I'm not that risk-prone guy I told you before. I'm 49, I still make 100,000 a year, 500,000 net worth, but I want to minimize losses. And so if the market falls 10%, I sell everything. So he comes up with an allocation to bonds of something like 40%. And then I changed the parameter. I kept everything, all the answers the same, but I just changed my age. I told him my true age, it's not 49, it's 88. And then, poof, the allocation to bonds jumped from 40 to 60%. Yeah. So that also goes against the idea of market efficiency. So we see that the robo is a kind of mixed bag. He should be an homo economicus, you know, where he believes in market efficiency. It's not possible to beat the markets, so you should only buy passive instruments. But then when you ask him questions, he gives you answers which are the ones that the advocates of market inefficiency give you.
Well, I've tried this site too. And what I have noticed is that it does look at other aspects of wealth management, such as taxes. Unfortunately, it means that you are only a US citizen living in the US. So how simple would this be to adapt to what is the average of the Swiss client, which is an international investor with multiple tax issues?
Right. Yes.
That doesn't seem to be.
It clearly increases the difficulty, and indeed it's a major challenge which the bank needs to address today. It's the fact that you have assets, you know, spread geographically, and each of the countries have, all the zones have different tax systems, so you need to be tax compliant, and it's a very complicated thing. But I believe, I mean, you increase the difficulty, but you don't make it impossible. Basically, you know, tax optimization does not entail market predictability. So in a sense, it's just a way of giving the robots all the information it needs to come up with an asset allocation which would be tax efficient, given the individual constraints. So it increases the difficulty, but it's not impossible to feed the robot with that kind of information.
So this is what it gave me as an investment plan.
Right.
I couldn't help noticing that most of it was Vanguard funds, which happened all to be passive fund and somewhat linked to the CIO of,
exactly.
of the advisor. So the question is really, who is this for? Because it's not for high net worth, that's for sure. It's not for institutions. Who is it for? The mass market? The guy has a...
It's for individuals, maybe not the ultra high net worth, but the affluent retail, affluent private investor. Some institution as well who only believe in passive investing. And indeed, I mean, what we have to know is that there are also a lot of academic research that shows that the bulk of your performance over the long run is achieved through your asset allocation. So it's way much more important to know when to be 60% in risky assets. And then when you see that the turnaround comes and then you enter into a bear market to shift to bonds and go to just 20% in equity or even less. So that decision is far more important than the individual security selection, the stock picking you do in each of the boxes of your asset allocation. Hence, you know, you pick up a fund in Japan, you have an allocation of 50% in equities, and Japan makes 10% of that 50%, so it's 5% of your portfolio, and you pick a fund, an active fund, which beats the market. I don't know, the Nikkei goes up 10% and your active fund goes up 15%. So, but the contribution, you know, you're making 5% of that 5%, so it's very low, and you're paying a lot of fees for that. So,
that's what
all in
pays
all,
your holidays.
yeah, and go to 50 million. No, but the thing, yes, there are even some institutions that believe you need to be active on the asset allocation, but passive in each of the boxes. So clearly, for that kind of investor, there's a market for fintech and for the robots. I think it's a very promising field, still needs fine-tuning, but very promising. And indeed, at the University of Geneva, we're going to organize a conference on that subject
I'm
after
looking
the summer.
forward to that.
After the summer.
Thank you very much for joining us today.